So this chart shows the S&P 500 real earnings yield as deflated by the headline CPI, the blue line, and there 6 times this has gone negative in the past. I don't know, 50 plus years.
Sorry, can you describe this? There's a lot happening here.
Sorry, this is the blue line is the S&P 500's earning yield, the real earnings yield deflated by realized headline CPI. So the earnings yield minus headline CPI, the blue line.
Okay. Yeah.
Whenever the earnings yield of the stock market, so it's an inverse way of looking at the price earnings multiple. So whenever the earnings yield, so it's another way of looking at valuation. Whenever the market has been this expensive as a function relative to inflation, this expensive relative to inflation, we've seen massive drawdowns. The minimum drawdown is 15% in this back test. It's a 6 out of 6 back tests, and it's a minimum drawdown of 15%. There's a couple 50%ers in there, or 3 50%ers in there. And so to me, like, this is the all-time low in this real earnings yield. Like this is again,
this is like the 15th like bearish chart I've seen this week.
It's and so go back to where we started the conversation. Asset markets are very buoyant, real estate assets in particular. The Fed is on it's increasingly feels like a train track towards tightening policy, even though we're heading into this.
Yeah.
That's exactly how you get a big market.
Powell did this in 2018 as well, right?
Yeah, exactly.
Well, it brings up the idea that a lot of these large corrections are caused by policy mistakes, where the misinterpretation of the data creates a situation.
I think they're mostly caused by policy mistakes. I mean, or like guns going off somewhere, but like policy mistakes is it? Yeah, totally. Their framework
hard to model.
Their framework is and now I've had a full glass of wine now.
This is when it starts getting interesting. We all make all the mistakes, and we all get
where it gets designed to have. It is a deliberate policy mistake. Their framework by saying, "Hey, we're only targeting, this kind of maximum inclusive employment shortfall objective, and we're going to actually change our inflation policy as a function or to facilitate getting to that objective," is a deliberate policy mistake. They're effectively trying to ignore impulses in the economy in real time to say we're going to ignore that to get us back to the promised land. That is, some people would argue if you just got a job and you hadn't been able to get a job, that's a policy success. But if you're talking about asset markets, that's probably a policy error because you're going to be behind the curve.
Amazing.
Yeah, I think when I look at a pure quant model, a pure trend model, and I look at their worst possible drawdowns, that has come at the hands of policy changes that were completely unexpected. Like the 1994 bond massacre had to do with Greenspan completely unexpectedly just raising rates in a manner that we hadn't seen in decades, right? Yeah. And he didn't project, he didn't explain it to the market, he just went ahead and did it. We saw it again in 2004, we saw it again in 2006, we saw it in 2018 twice when Powell came into power, right? We saw it in January, and then we saw it in August. Like every single time, and then they have to about face within months.
Yeah.
Right? Like
I think that's what's different though about the current Fed, that they've demonstrated a capacity to about face very quickly, and when they do, the policies that they enact are orders of magnitude larger than what the market is prepared for and what we've ever seen before, right? And that trajectory keeps accelerating, right? I mean, they rolled out the same set of tools that they used in the 2008 crisis. It took them 18 months to roll all those out in 2008-09. It took them about 18 days to roll it out in 2020, right? So this is what I mean by this sort of reflexive nature of this market, right? I mean, you've got a massive amount of speculative fervor, narrative fervor, to your point, Darius. You've got negative dealer gamma across all the major indices at the moment. Like we are primed to be in a critical state. So a minor shock can nudge the market in one direction or another to a much larger magnitude than people are used to. And the government's and the Fed's reaction function is, if you're using the recent past as a guide, a massive unknown in both directions, right? So, these are the reflective dynamics that investors need to navigate here. And I think this makes this market one of the hardest markets to navigate that we've ever seen from a risk management standpoint. So, and what's great about this, Darius, and to Rodrigo's point too, all of us on this call are positioned for dispersion against the common indices at the moment, right? Certainly our portfolios are as well. That's very exciting. I mean, we are going to experience dispersion in one direction or another, right? But that is how you differentiate in this business, and this is how you demonstrate the long-term value that you're, going to bring to investors. So, these are pretty exciting times. I really like the framework you've delineated. It's amazing to observe the amount of commonality actually from an ensemble standpoint in terms of like the ensemble of signals that you're using, the humility of using all of them. We don't quite use them all in equal weight, but just, acknowledging the error term in the strength of any one signal to signal the market state that you're in at any given time, and the market positioning that we're beginning to observe in our models and your models. There's a lot of overlap there, and it's exciting. I'm looking forward to some dispersion for a change.